Hello value investors, thank you for joining me. In today's video, I want to talk about Peter Lynch and why his investment strategy is not particularly applicable in today's modern market. So if you're new to the channel, please subscribe now so you can get my next video installment. This is our value investing journey. Let's get started. If you're watching this video, I assume that you know who Peter Lynch is. And I'll assume that you know that he was investing the Magellan Fund and that he, throughout his 13 years, had a compounded annual rate of 30%. This by far and wide puts him in the Wall of Fame of the top investors ever. So, why is this particular strategy not so applicable today? So if you look back and you read One Up on Wall Street, you'll see the period that Peter Lynch was investing in. So he was investing from approximately 72. I think the fund was closed for the first 2 years to invest, to kind of just get a track record going. And then I think it kind of might have started in 74, I believe it might have been, so that, and it ran till the end of the 80s. Now, that point in time, when the US, it was predominantly mostly the US, and it's particularly investing in companies that had business models that were very well predisposed to massive expansion. So like barbershops and this sort of shops that work very well inside a mall. So you could go and you could visit the mall, and pretty much what works in a mall in one area could be pretty much put across many different malls in the United States. Walmart, this kind of idea. Now that problem is that there has been an overexpansion over time of mall shops. Furthermore, if you look today, we know the brick and mortar has really struggled. So it's the message that things change over time. You have to adapt. You have to kind of know very well what is your circle of competence. However, you cannot stay within that circle of competence forever. Look at Buffett with his migration over to Apple. Yes, you can justify that Apple is a consumer business. You can say that IBM is an entrenched business. But over time, you have to adapt it. When Buffett originally made his investment in IBM, he said jokingly, I've been watching this business for 40 years, and I believe now is the best time. And that did not work out so favorably. That is not in any way to push down Buffett. It's simply to say that adaptability of his mind. So over time, you have to go out of your comfort zone. That's why Charlie Munger calls Buffett the learning machine, because he keeps on learning. So we have to learn the same. So you gotta know your circle of competence, but you gotta be willing to adapt that. So going back to the Peter Lynch and his investment strategy, I'm a big fan of Peter Lynch, and I get the absolute core of the strategy. It's a value strategy. I know that there are some aspects of it that you could say, oh, he's a growth investor, but by a stretch, this is kind of just getting a bit nuanced. And I do also delineate something that is a growth and something that is a value. But what we're all trying to do essentially is buy something for less than it can be worth. So what I do like very much about Peter Lynch's strategy is that assumption that if you're buying something on a smaller ratio or PE ratio or PE multiple, price to earnings multiple, than it's growing at, that can make for a very strong investment. For example, something is priced on a PE of 20, that means you're paying $20, you're getting $1 in earnings. But if that investment or that business is growing at, let's say, 30%, for instance, that's a very good return because you got your price to earnings. So you're paying your $20, getting $1 in earnings, but that dollar is growing at 30% in this example. So if you do this 20 divided by 30, you can see it's less than 1. That is a reasonable investment, so that's when a PEG ratio is less than 1, that's particularly interesting. Conversely, if you're saying that a business is growing at 10% and you're paying a P of 20, so that 20 divided by 10 is not as an attractive business, it's over 1. So you got to try to consider the growth of the business. So Peter Lynch's idea is absolutely spot on. Trying to get a business that is growing faster than its multiple implies. So that's right. What is not so applicable is that you as an investor can go and familiarize yourself either online or elsewhere with a product. You can't possibly know the nuance of every sort of product. You might be an engineer in a SaaS world, but if you're just buying SaaS stocks all day, every day, you kind of, it's a competitive market. You haven't got a lot of diversification. Let's say you know a lot about cars. Okay, you like Tesla. Tesla's like your thing. Okay, fine. No comment on Tesla, but you might have an investment in Tesla, but you got to have some diversification. So how do you get around that? So it all circles back to demanding that circle of competence and demanding that margin of safety. So you intrinsically understand, okay, I need to buy something with a large margin of safety, but I'm never going to know everything about the business. Consequently, I need a larger margin of safety for that uncertainty, that unknown. So, in summary, I very much look to Peter Lynch as a mentor, and his PEG ratio is very strong. It helps you. It pretty much cuts through a lot of noise. However, it's very difficult you as an investor to know about every sort of business because you might end up in a niche and that niche can go through some very difficult times. So you have to go back, have a large margin of safety. Hope you found this video useful. I'll see you soon.